Hello and welcome. You're watching Business Plus. The US Federal Reserve hiked interest rates by 0.25 percentage point, making it the 10th hike in the current cycle. The central bank's Federal Open Market Committee (FOMC) raised its benchmark borrowing rate by 0.25 percentage point. The increase takes the Fed funds rate to a target range of 5% to 5.25%, its highest since 2007. The rate sets what banks charge each other overnight lending, but also feeds through to many consumer debt products such as mortgages, auto loans and credit cards. Now, while the FOMC statement hinted at a pause, Chairman Jerome Powell said that the central bank was prepared to lift rates higher if needed. On the show today, impact of the latest US Fed hike, fears of looming recession and what it means for the banking crisis going at large. With me at this point in time, Subhomoy Bhattacharjee, who is a consulting editor at Business Standard. Also joining us, Amit Gupta, founder of Fintrekk Capital. In the studio with me, my colleague Kartik Malhotra. Don't forget to click the bell icon and subscribe for more such stories before we start and move on. Let me come to you, Kartik. Another Fed hike, what does it really mean?
Yes, another FOMC meeting, another Fed rate hike, not totally unexpected. In fact, largely on the expected lines, 25 basis points is what everybody was expecting. And there we have it, Fed has delivered 25 basis points hike. Like you mentioned, this is the 10th hike, 10th consecutive hike. Fed started tightening its monetary policy in March last year, and this was just at the onset of the Russia-Ukraine war, which sent inflation soaring high across all countries, US included. Now the point is US inflation has continued to be sticky, and it's very difficult for Fed to continue to keep tightening its monetary policy and hope that over time in the long run the 2% target would be achieved. Jerome Powell continues to be watchful, and he hasn't ruled out another Fed rate hike. At the same time, he has also hinted that if inflation does come under check, or if signs of inflation coming under check happen, then they may actually hit the pause button next month.
Okay, Amit is here with us. Subhomoy is going to come in just a while from now. Amit, the tightening of monetary policy, as Kartik said, how far is it justified to control inflation which still continues to hover around 2%, and this being the 10th consecutive hike, not really helping the US economy?
Yeah, hi Shweta, thanks for having me. So I think there is a little bit of uncertainty in the policy action post this rate hike, which a lot of people are construing as the last rate hike in this cycle. The banking crisis is a major thing which has happened in the past 2 months in US. But the core challenge, I think, still remains inflation. Because if you look at the latest the core personal consumption reading which comes out from the US, which excludes the foods and the energy, that is still quite high at almost 4.6%. So I think the sticky part remains the non-housing related services inflation, which almost makes up for 50% of the inflation in the US. And that is not showing the signs of easing out. So I think that's why, the commentary which Powell gave out last night and in general from other Fed members, which we are seeing, that they don't anticipate the 2% inflation target to come in a hurry. And that's why they are not committing for a rate cut. All they are committing is that because they have done, these 10 almost rate hikes in the past 14 months, they want to stay higher for longer and then take a call how the economy is doing, and then maybe do a rate cut. But at this point of time, they are not committing for a rate cut. Okay. So my sense is if the economy goes into a recession-like conditions, or there is further slowdown in the US, then only I think we'll see Fed changing their stance to rate cuts.
Okay. Amit, before I come back to you, I want to bring in Kartik here. Kartik, although there's been a change in stance and an omission of a certain statement that says that the committee anticipates some additional policy firming may be appropriate, that statement has been let go of. Yeah. However, Jerome Powell hinting that if needed, we will hike interest rates again. But could we see this as the last Fed hike in a while?
Very difficult to say, Shweta, and I think US is right now at a very precarious situation. We've seen these constant rate hikes, what they've done to the banking sector in the US, and banks have been fairly badly hit, and we've seen 3 fairly large banks go down. Now, what really, at one level, of course, with these hikes, you're trying to tame inflation. What this is also doing, and that is the intended purpose of any monetary tightening, what this is also really doing is that, the credit offtake takes a beating. Higher interest rate means fewer corporations going to banks and leveraging themselves, fewer individuals taking credit from the bank and expanding the economy. So my fear is that US, if not a recession, could definitely look at a stagflation kind of a situation in the immediate run, wherein you see that interest rates are high, inflation is high, but economic growth, economic activity is rather slow. And that becomes a very difficult situation for the US to sort of, crawl itself out of. The second fear that I see, and I hope I'm wrong, but the second fear I'm really, contemplating in my head right now is that the small banks or the mid-sized banks which are taking a beating because of this lower credit offtake, to keep them afloat, they are being sort of gobbled up by the larger banks like JP Morgan. We just saw, just about a week ago. Now, these big banks which are already too big to fail, and these big banks which are systemically important banks are now becoming even bigger to fail. And they are sort of, bloating up in size. Any one of them gets punctured, gets burst, the catastrophic impact that's going to have on the US economy is actually going to be pretty much similar to what we saw in 2008. Also because the rates right now are fairly similar, in the same range almost, to what the rates were in 2007. So is the US actually slowly, gradually building this big banking bubble which could actually get punctured and have an impact on the US economy and on the global economy at large?
Okay. Amit, the banking crisis in the US is not building any faith amongst peoples, and this another hike, 10th consecutive hike coming in there on the face of the fact that regional banks are collapsing. The Fed, of course, is hoping for a soft landing, but that's not going to have a good impact on the banks per se. Regional banks who are not going to lend out, they're going to be extra careful now before lending.
Right. So I think last time also, when the First Republic, before that, Silicon Valley Bank got busted in March, we had a discussion. And then also, I said that, we have to look at next 30 to 60 days to see if there are more banking crises in this. So my sense is that this is probably not over. Even after the Fed meeting was over and the press conference was over, one of the banks, PacWest Bank, has actually said that they're looking out for a buyer. And there are at least 3 or 4 more regional banks which are under the hammer. So my sense is that probably at this point of time, Fed is probably underestimating the effect of credit tightening. I assume that this would sort of restrain more investments and spending, leading to lower jobs and demand in the going forward. That could help getting inflation quicker. But the financial stability concerns are not really going off. And the central banks need to be very, have a leash on how they want to control this, the regional banks issue, not, going out at a very large level. So far, it has been contained because they are providing the backstops, and the FDIC is basically providing all the insurance deposits. But there is already talk that for accounts which are more than $250,000, they need to provide backstops to all that. So I think in the next 15 to 30 days, we are going to have more clarity on that aspect. But at this point of time, the financial stability from the regional banks, that's a major concern for most of the equity participants.
I agree with you, Amit, and in fact, I echo what you're saying, and that's something that, I agreed with you last time around also, and we saw when you mentioned in the next 30 to 60 days, another bank could go down. It actually did. First Republic went down last week. But talk to me specifically about the concerns on stagflation. Do you think US could be heading towards a stagflation environment?
Yeah, it could be a possibility if Fed hikes even further against the expectations, or they keep rates at a higher level for longer than expected. We need to see that the currently the market is actually pricing rate cuts by 2023 end. So sometime in December or early 2024 January, market is actually expecting rate cuts, and not just one rate cut. They're expecting actually three rate cuts. Whereas at this point of time, we are at the max at pause. If we assume that June is going to be the pause meeting, the key concern here to understand is that if stagflation kind of issues happen, then Fed would be forced to cut rates. So I think the call is whether Fed is going to cut rates because of stagflation or recession-like conditions within the next 6 months, or they are going to take longer. I would think that the macroeconomic conditions would define that, but stagflation towards the end of the end of the year is a quite a possibility in US.
And what do you think is going to happen at the next RBI MPC? Because last time that Shaktikanta Das paused the rate hikes, he categorically mentioned it's a pause, it's not a pivot, and we've seen inflation in India has sort of started to ease a little bit. So finally, do you think that pause is going to convert into a pivot and we will actually start seeing loosening of the monetary policy? Because I think rate hikes in India are definitely ruled out. Or do you think US continuing to tighten monetary policy could have maybe another 25 basis points rate hike in India?
No, I think RBI actually front-loaded the Fed decision of basically going on a pause. So I don't think, given the comments which were made afterwards and the Monetary Policy Committee minutes which came out in late April, that clearly indicates that we are going to be paused, and this is probably the end of the rate cycle. Whether the next decision of rate cut would come in 3 months or 6 months, that we need to see. Because in India also we have to see how the monsoon behaves and whether that leads to a rise in inflation again or not. But at this point of time, I would say RBI is probably done with the rate hike. So is Fed, and the next step would be rate cut. But whether that happens in 3 months, 6 months, or 9 months, that needs to be seen. So just to answer your question, I think we are done with the rate hikes in RBI.
So pivot maybe 3 months, 6 months, 9 months down the line.
Okay. Shubhamoy Bhattacharjee joining us at this point in time. Shubhamoy, who is the consulting editor at Business Standard. Shubhamoy, do you agree and concur with what our experts had to say here, that this could essentially lead to a stagflation kind of a situation, and then Feds may look at cutting interest rates not in the near future, but towards the end of the year?
Well, that's an interesting question about the stagflation. Let's look at it this way. What are we saying? We are saying there's other word that they're using, which is that whether there'll be a soft landing or whether there'll be a hard landing. What do the two mean? Well, a soft landing will mean that the wage inflation has to come off sharply without the unemployment rate rising very fast. Okay, so that means that the inflation has to come down, which would make the which would allow the US Fed to soften the rate, at least to go off from the rate hikes, as Amit was saying right now. But the unemployment rate should not rise. Now, that will require a sharp increase in labor force participation. So we are saying that wage inflation is not there. It isn't encouraging the people to take more jobs, yet unemployment will not rise. Now this strike is difficult to have. So that sort of a recession that sort of possibility doesn't look possible, likely to be. So what is the other possibility? A, that credit conditions tighten after the banking stress, policy rates peak, and if the policy rates peak, then we get by with a mild recession. Or there is the Fed moving in small doses still towards 6%. So essentially we are saying that the risks are more towards whether there's going to be a hard landing or a soft landing. Stagflation has to be looked at. Is that the inflation is continuing, yet there is no growth. I would say that sort of a situation, that sort of a word, I wouldn't use it right now. What we should be looking at more, therefore, is whether the economy in USA will be moving on with us, right? Continuous rise in people demanding work despite wages not rising high, or will the growth phase be pushed back by the conditions of credit tightening because of the banking stress, because of the higher cost of money? As you can see, these are difficult combinations.
Yeah.
Basically means that essentially what experts are saying is, therefore, other words of saying is we don't know. That's one way of putting it, the best. But the point is that you can't have both a Fed deciding to reduce inflation, or rather, Fed deciding to soften the interest rate, soften the inflationary spiral, yet the economy not responding in an adverse way. So what are the possibilities? One is that through the wage rate, one is through the unemployment rate, other is through the banking rate, that people don't take out too much of credit.
Yeah.
Frankly speaking, when you include the issue which Amit and you were discussing about a banking crisis, that is an external element that comes into this discussion. Okay, now that sort of an external element, when it comes into the discussion, takes away all possibilities of any, whatever we are discussing becomes useless at this stage to think of as a possibility at this, to sort of factor in, because those are sudden. So what you call the black swan event. So
I just wanted to come in there and ask at this juncture, how much of the banking crisis is going to affect the hard landing, or rather spur a hard landing?
See, there's already a crisis here because of the fact that the Fed is continuously raising the cost of money. Just give me a second out here.
Sure. Kartik, I think that's an important question at this juncture. We are obviously, the expectation is that of a soft landing, but a lot of external factors that will also come into play, including the banking crisis.
Yeah, so I don't know, we'll have to go back to Subhomoy and understand what are these external factors, because another black swan event so quickly is going to be catastrophic. Absolutely. And I don't think anybody is really expecting that at this juncture. But I think whatever the Fed is doing by tinkering with the rates continuously is making the smaller banks unviable, because credit offtake is not happening. And if that continues to be the scenario, then, like I said, it'll be difficult for the small banks to survive, because their entire business model takes a beating. And therefore, them getting gobbled up by bigger banks becomes a bigger concern, where the big banks become, in any case, too big. And if any one of them goes down, that becomes a black swan event in its own.
Subhomoy is back with us. Subhomoy?
Discussing, I heard what you're saying, and your points are very, very valid. A black swan event, by definition, we really can't see what will happen after that immediately, because there are lots of risks in terms of people's care, reputation, so many things come. So let's not have a discussion. I would say that we should take that as something that can happen, and if it happens, then we'll have to play by the ear.
Yeah.
So that is not something that on which we can really, look ahead and anticipate a black swan. In that case, it's not a black swan.
Correct.
So basically what we are saying right now is that whether the cost of money rising is making it too intolerable for the banks out there to take any risk. So let's just limit ourselves to that. And that itself is a very major thing. What the US Fed is saying is, not only by fact that it's raising the rates, and its commentary incidentally isn't saying that it's really done with it and all that. It's still saying that it's on the, it's looking at interest rate, it's looking at inflation very carefully. Now, given that sort of a thing, it's basically saying cost of money is going to be very high. A. B. Not just the US, across the world, all central banks are raising their, getting very annoyed about the prospect of risk in the banking system. Now, that means that essentially they're saying we don't know where risks would come from, so we shall do as much as possible to weed out all risks. If that happens, banks are supposed to take risks. Whenever the bank lends out to anybody, a bank takes a certain amount of risk. If the entire risk is going to be on the business, the borrower, and the bank say, I'm going to have absolutely like a risk-free environment, basically invest in securities paper of the government, then that is a very untenable financial model. And I think that is the larger risk that we are moving towards.
But Subhomoy, Subhomoy, if I can just come in, isn't the biggest risk to the US banking system right now the US Fed itself? Isn't the Fed Reserve constantly tightening the biggest risk because there is no credit offtake and the whole business viability of banks comes under question?
Absolutely. So why is it not happening? Because the banks are saying that first of all, the cost of money is getting higher. That's
correct.
Also the regulations. Look at what's happened with Silicon Valley or with First Republic. They were not doing any problems with their accounts. They were simply trying to earn an extra bit of money by taking risk. That risk has been shown to not work. Fair enough. But does it then therefore mean that banks will not supposed to take risks at all? Because that is the essential commentary that is coming out all over, not just US Fed, but even from other commentators. Because if that means the banks will not be taking risks at all, they just work on the 3-6-3 principle.
Yeah.
Then in that case, what is the bank supposed to be doing for the larger economy?
True.
And if that is the sort of things, then if risk is to be taken entirely off the table, then where is the relevance of the banking system? And I'm getting into a very difficult area here. Where is the relevance of the banking system as far as the financial sector is concerned? The financial sector will say, fine, that I don't need the banks. I'll go in for raising debt myself from the market. I'll use commercial papers. I'll do private placement. I mean, all sorts of things.
True.
I'll not use the traditional banking model. In which case, the banks, and you rightly pointed out, the banks are being forced into a model which I think is a unsustainable set of model. You can't take risk off the table completely. I mean, every commentary that is coming along says that risks have to be lowered substantially.
Yeah.
I mean, if that essentially is saying that essentially is the other way of saying that we don't want any risk whatsoever. If you take a risk, we are going to come down big time.
Right. So Subhomoy, we are running out of time. So I just want to quickly get your perspective on this. I asked this to Amit already. What is happening with the banking sector at large, as I see it, is that the big banks in the US, which are swallowing up the smaller banks, which are in any case, the big banks are too big to fail. Now they're becoming even bigger to fail. Any possibility of any one of them getting bust is going to have a fairly deep-rooted impact on the US economy. Do you see that as a probability? I want to specify on the word probability, not possibility.
Yeah, that's again a very good question. Let's look at it this way from what we have been through earlier. Lots of our banks, when they used to fail, New Bank of India and others, big banks were told to swallow them. And what happened when those banks swallowed them up? They found that there were deep pockets of loans not really adjusted, extra capital that was needed to be deployed to keep those banks in shape. I think US is going down that road. So essentially, it is actually making the banks, the bigger banks, more difficult for the bigger banks to do their normal business.
Right.
If every time they have to take, it's almost around $538 billion or $550 billion that has been adjusted for by these big banks. That's a hell of a lot of money. If that sort of money has to be accounted for on their balance sheets, the banks will not have space.
Absolutely.
We have been through that in India. So actually, we can actually tell them that, look, don't go down that road. Banks are not viable, they have to be closed down.
Right. Amit, before we wind up this discussion, so if US were to head into a recession, who is the single biggest enemy of the US economy? Would it be inflation or would it be the US Fed?
So that's a sort of a chicken and egg problem. To control inflation, Fed has to do a rate hike.
Yeah.
And if they do a rate hike, then
should US eventually blame it to external factors or internal factors?
Sorry, I didn't get that. What?
External factors causing inflation or internal factors like the US Fed?
Tinkering monetary policy.
No, it was definitely the money which, central banks threw at the COVID pandemic, which led to the inflation going high. And then obviously the Russia-Ukraine crisis happened, which sort of accelerated the inflation and made it more, core in nature. But I think we are doing well in the last sort of 6 months or so, where the inflation is going down. I think Fed has also got a sort of a idea that if they tighten up further, then there is going to be financial stability issues. Remember, we are already with the latest rate hike, we are already at 2008 global financial crisis peak of interest rates.
That's right.
So just before interest rates, just before the global financial crisis, we were already at this band, 5 to
Right.
5.25. So I think they already know. So they'll go on a pause. They'll stabilize it. There is an additional issue of debt ceiling limits on 1st of June. They're going to sort it out because Fed cannot intervene in that, but that's a political
Right.
issue needs to be sorted out. So they'll wait and watch probably and see how things unfold over the next few months, and if there are no further surprises,
Right.
I think we should see some rate cuts happening by the end of the year.
Okay. Amit, Subhomoy, thanks very much, gentlemen, for joining with your inputs on that story. With that, it's a wrap on this edition of Business Plus. Keep watching.